Hey everyone, welcome to Bald Convos. Fun show that we do live stream every Friday at 2 p.m. Eastern. I'm joined by Branden Fini, who's a partner at Providence Ventures, and Brad Otto, who's a partner at SpringTide Ventures. We have a fun conversation. How you guys doing?
Great.
Doing well.
Glad to be here.
Yeah, excited to chat. Thanks for doing this. And we're trying. You guys are the first that we're trying out the new stacked format. We're trying to be hip here, right? For those that are on their phones, but even it looks good on just a browser as well. So excited to chat. Let's dive in. Maybe if each want to spend like just 30 seconds, just we'll start with you, Brad, then we'll kick it over to Branden. Just for those that maybe do not know you, to get to know you a little bit, and then we'll dig into some of our conversation today. One of which is digital health dead. So we'll start with you, Brad.
Yeah, absolutely. Super excited to be here. I'm a partner at SpringTide. I've been with the firm for a little over 3 years, and we invest in all things early stage healthcare. Prior to SpringTide, I was at United Health Group in the corporate venture capital team, and I always joke our model is basically to copy digital health startups that kind of already existed in the market and just build them and distribute them internally. So that gives me kind of a unique perspective on the market. And I started my career as a healthcare investment banker. So been in the industry for a few years, based in San Francisco.
Thanks, Brad.
Yeah, thanks. So Branden Fini, I'm with Providence Ventures, healthcare tech, digital health focused venture fund. We've been around for 10 years. I've spent my career pretty similar to Brad, actually, minus banking. I spent the last decade in almost exclusively direct healthcare investing roles, kind of across the private investment strategy spectrum. I started out in lower middle market privately with a fund in Southern California that did mostly life sciences focused things like pharma and biotech. More than half of our capital actually came from physicians, high net worth physicians. So that's really where I cut my teeth in investing. Worked with over 1,000 of them over my time there, and then I've slowly kind of moved to earlier and earlier stage strategies. Ending up in venture capital about 5 years ago, doing really anything with technology, whether it's pure SaaS or a tech-enabled service, which is mostly what we do. And I'm based in just outside of Salt Lake City.
And both of you have invested in a lot of companies and had a few exits throughout there. Some especially notable ones. I've first met both of you. I believe it was at like Health or the Vibes we were talking about a little bit before. Branden, I think we met at like Health. Was it 2021 in Boston at that?
Yeah.
I remember right in the front. And then Brad, I think we chatted before that, but it was at Vive Nashville. I think that I saw you.
Yeah, that sounds right. Yeah.
Yeah. And what I'm really excited to have both of you on here today is to kind of get your perspective on, the big topic that we'll talk about right now is, maybe this is dramatic, but is digital health dead, right? We all know it's not, but I have read that kind of note in a lot of different places online. And I think people do say it because it is dramatic. So we'll get each of your take on, is digital health dead, and maybe what the next progression of digital health looks like. But then also kind of want to get inside both of your minds in terms of, advice that you have for early stage founders and what you like to see out of the companies that are in your portfolio. But we'll kick it over to you, Brad, and we'll switch off the questions. But is digital health dead?
Yeah, thanks. It's an interesting topic. I mean, I feel like we've all seen these kind of clickbaity headlines on this. Been the past couple of years. I feel like it's been kind of the like whipping boy of the industry. I wrote a post about this the other day, and my take on it was really just like, I think it's kind of a silly definition. I think the term digital health is, I don't know exactly when it emerged. I feel like it was kind of purported to be like this new emerging industry, like over the past decade. And I think that just kind of missed the mark when you look at like healthcare technology on a longer horizon. I feel like Epic was founded in like 1980 or something. So we've really had like a couple of decades of healthcare technology, software-based businesses in the healthcare system. And so the point that I was trying to make the other day was just, I think the term digital health probably needs to be retired. And, we can just talk about like healthcare and technology and the intersection of healthcare and technology more broadly. Digital health is not dead, and, it will continue to be like very interesting sector for investment and for entrepreneurs. But I kind of take issue with the definition. It feels like it's like this small kind of sub industry of healthcare, when really like everything should be digital in healthcare. And if it's not, then it's probably by design.
Yeah. I was going to say something similar, like define digital health first, and then define dead. I mean, digital health. I remember it used to be called healthcare IT, and healthcare services. And then I remember, anyone can contest me on this point, but when I first started hearing the term digital health was in 2017. I remember exactly when I first heard it. Like, I was having a conversation with a friend at business school, and this was when I had just spent years in the life sciences, and I wanted to broaden my view into healthcare, and I started getting enamored with a lot of the inroads that information technology was making. And the reason I did was because for the first time, healthcare technology wasn't just about EMRs and revenue cycle and a lot of these legacy categories that Brad was alluding to. It was also making inroads into clinical applications and actually treating patients, like digital therapeutics. And we can talk about digital therapeutics if we want to, but the point is I started getting pulled into this world, and people were telling me, oh yeah, that's called digital health now. This new category, digital health. And I got pulled in because I was very intrigued by digital health. But then once I got really deep into it, and now it's been several years since that point, kind of reinforcing what Brad said, digital health is like, it's not really a category. It's more like healthcare as an industry has this opportunity to go through the evolution that any other industry in the entire world has gone through, which is modernizing and adopting tools that the world has to offer. In this case, it's a mix of technology, information technology reinforced by data, but also organizational innovation. So when you think of like delivering care differently and having a different care model, there's some technology in the back end, and it may be infused throughout, but it's not purely a software solution. It's like doing something differently from an organizational standpoint. And people put that in the digital health category, when in reality, it's like, it's I don't know what you call it. It's just doing something differently. You can call it whatever you want. So long way of saying the definition of digital health is problematic. And then like getting into certain categories, and then I'll stop, is it's true. I know why people are saying digital health is dead. It's because some categories aren't attractive. Like it's, even though it's been around forever, it was the ACA, Obamacare, that I think laid the foundation for an explosion and need for digital health as we understand it, because of value-based care shifts, and also like the availability of data and the adoption of EHRs and the High Tech Act. So like I get why people say that, but some categories just aren't attractive, and some customers aren't attractive for certain solutions. It's still an evolving market, so not everyone's going to do well. Most people don't. So.
Do you think the pandemic brought along, though? It seemed like it brought along a lot of companies that I don't want to call copycats, but there was just so many of certain types of companies, and then we started to see that consolidation happen, right? Whether they were shutting down over the last year or two, or whether they were getting acquired, whether it's an asset or an all-out sale. Do you think we'll continue to see consolidation still for the kind of remaining companies that are in the space, and we'll only have a couple key players over the next, let's call it 2 or 3 years, and then we can bounce back and forth again?
Yeah, it's an interesting question, and I think it's a very interesting timing when you kind of overlay like the pandemic across the run up and kind of the bubble, and like, I'll say bubble, maybe that's maybe too strong of a term, but like the bubble in, what we're describing as digital health. It probably like extended that bubble by a couple of years, just based on like, the unique timing. I hadn't really thought about that before. Certainly like it extended some care models and opened up some new care models. To your question around consolidation, like, I think, yes, I think there's a lot of consolidation that is still remaining to happen. But these are normal cycles that every industry goes through. So I don't think it's like it's the doom and gloom around, this whole industry kind of being written off. To Brandon's point, like there are some sectors that are like less attractive, some that are more attractive. You know, I think about like the .com bubble. I certainly wasn't investing at that time, but like I just imagine being an investor at that time and like kind of seeing the sky falling on this whole sector, but then like all of the incredible innovation and like businesses that were also built during that same period. So it feels like, maybe kind of an interesting comparison to what we're going through now.
Yeah, I strongly agree with the cycle sentiment. If you look at the trends right now across the market, not just digital health, but across the capital market, like the trend of acquisitions, number of acquisitions, amount of financing, venture funding, private equity funding, and stock prices and that sort of thing, and you overlay that trend with the .com boom and bust, it's very similar. It's eerily similar, and that's not a coincidence. It's because we're in a cycle. Now, I'm not an economist, so I'm not going to pretend like like the definition of recession changes every day. So I don't. But my understanding is, the economic outlook right now is much better than we thought it was even 12 months ago. So the extremity and the intensity of the .com boom and bust is likely not to be replicated today, but the shape and directionally, it's very similar. And so, what does that tell us as investors? It tells us that it doesn't. It's likely doesn't pose an existential risk to various categories. I think when you look at the stock, like the multiples in the market and how the market responded to certain categories, healthcare and especially digital health was hit harder than other categories. I think the only exception was fintech. Fintech took the biggest hit in 2022 after the exuberance of 20 and 21. Digital health wasn't too far behind. And to me, it's not so much a reflection of the like prognosis of digital health in the long run, but more an indication of two things. One, that the digital health category, despite its legacy roots, has grown a lot and proliferated a lot since 2010 with ACA. So the market's still figuring the sector at large out. That's number one. So there's the calibration and there's going to be overcorrection, I think, or there has been overcorrection. The second point was because of COVID, technology and healthcare got more exuberance than most other sectors, and so there was an overreaction to its potential, and as a result, there was an overreaction to its long-term view by investors. So I think that's what explains the volatility that we've seen.
If I could just respond to that,
Yeah.
I think that's a really good point. And like, frankly, I think a lot of this is actually very healthy for our market, whatever we're exactly calling it. Let's just call it healthcare, because there's a lot of fundamentally just unsound businesses that were funded and existed for probably longer than like they should have in a rational market. And so, we're seeing this like return to unit economics and like a return to seeking
And to
profitability.
fundamentals.
Yeah, which like is just, it's good for everyone. It's ultimately good for patients when you have businesses that are operating on like sound fundamentals. So I think net like this is positive. Frankly, we at SpringTide have probably our deployment pace over the last 3 years, like including 2021, has been relatively stable. But this year probably has been a little bit higher than average because we're seeing just an incredible amount of opportunities, a lot of really great businesses being built, and a lot of innovation in the sector. So I'm super excited about it.
When it comes to these, oh, sorry, Branden, if you want to add something to it, go ahead.
Yeah, I was just saying, like, to Brad's point around just like look at the fundamentals. What drives business fundamentals, around adoption, growth, unit economics, profitability, sustainability, all that sort of thing. What drives that? It's the needs of the customers actually adopting the solutions they offer. Like at the root of it, it's the needs of the marketplace that they're serving. And when you look at the needs that these types of tech-enabled platforms can address, those needs in healthcare, like to name a few, like costs are going up, average premiums for individuals and families keep going up. Hospitals are struggling with their financials. Payers are struggling to engage members in the right way to drive the right behavior change. The provider shortage is intensifying. These are all trends that uncover growing, like ubiquitous and growing needs in the healthcare marketplace. And so the needs are there. Therefore, the appetite for effective solutions is also there and also growing. So, like on a very fundamental level, this category, if delivered effectively, isn't going away.
What are you both seeing an abundance of AI heavy pitch decks coming through, like with these companies that you're talking with? And at what point do you have to? I'll first let you answer that, Brad, but then we'll kick it back to Branden. But I'm sure you're probably seeing a decent amount, or like, are you hoping that each of these companies are presenting these AI focused solutions, just given the times that we're in?
Yeah, I mean, yes and no. I would say there's definitely been an increase. That's for certain. I think what's probably most prevalent for me is like I'm just seeing kind of like AI being sprinkled into places where I'm not sure that it's like really necessary or even existent. I think we're I don't know about but like folks are calling things AI that like historically would have just been called something different. So I think for us, like at SpringTide, we've just been thinking a lot about like what's kind of truly novel here. What are like new business models that are being enabled, new products that are coming to market that aren't just being like rebranded from statistics or something like that.
Yeah, the short answer, Jared, is I am not seeing a sudden influx of generative AI businesses in healthcare, which might, I don't know what that means. I mean, we sit and we're not these early stage investors. I think like Brad, your team is like a click before us.
Yeah.
And so after that early stage filter, the sales pitch and the value prop might morph, and then it comes to us. I'm not sure, but what I will say is our view on AI in this space is like at the end of the day, these algorithms are like freely available. A lot of them are open source. As long as you have computing power, so if you're operating on a public cloud, Azure, AWS, whatever, if you have a public cloud for computing and storage and a network, you have the right talent, then you can build these. You can build and access AI yourself. I think the differentiation in healthcare will come from a combination of your training data. So you need to have unique and sufficient access to the right amount of training data for whatever use case you're solving for. And then you need to, and this is something so many people from like a tech first background miss, it's probably just as valuable. You need to be compatible with the native workflows of your users in healthcare. The doctors, the nurses, the other licensed caregivers, the administrators, whoever's using it, like it needs to be a seamless experience. It needs to be integrated with whatever EHR they're using, whatever IT systems they're using. And if you don't have that in mind, and you're not delivering, business or clinical value, whatever it is the users want, like it doesn't matter how slick the algorithm is. And I will say, as a general rule of thumb for technical modalities, so whether it's generative AI or machine learning, or use your whatever buzzword you want, like at the end of the day, I don't think the customer, the ultimate adopter of the solution, cares about the back end workings. What they care about is the results you deliver for them in a cost effective manner. That's it. So that's those types of companies are going to be the ones that are successful, I believe.
You said it, Branden, a little earlier, that SpringTide's like that click before, right? Which makes sense. I would love to. We'll start just because of that click before. We'll start with Brad, and then we'll kick it back over to you, Branden. But how, like, what you like to see in these pitches from founders. I think that's something I would really like to hear. And then so we'll kind of get it from Brad's point of view, and then over to you, Branden, because I know you'll probably be looking for some similar but still some different things. So, obviously, let's say, Brad, that you meet someone, you have some relationship with them, you've heard of them, you've had conversations, and then they're coming in, they're doing some pitch to you. What do you need to see in that meeting that continues your interest for that next meeting, or to say, we're going to heavily do some due diligence into this company?
Yeah, absolutely. Well, so first of all, just one of the things you mentioned is like, we get a warm intro or we know a company. That is certainly not like a criteria for us. Like my email's on our website. Anyone can reach out to me. I literally look at every email. So that, that's not a criteria for me. I don't need a warm intro to anyone. So my inbox is open. The thing, I think, beyond the basics, like, of course we want to know about the market size. We want to know about the problem statement. We want to really understand, like, if you have an MVP and you have kind of traction in the market, like we want to really deeply understand that. But I think one of the things that maybe is often overlooked is I really like to hear about like the founder's relationship with kind of the problem that they're solving. So, call it like founder market fit. And that's something that I think at the early stage in particular is really important to us, because these businesses are not fully baked. We're comfortable investing pre-revenue. And so what kind of gets you through that process and those, the iterations that you need to go through to kind of get to product market fit is like a real deep passion for the problem that you're solving. And so that's something that I think, like, I always like to start off a pitch with that. And if we haven't started with that, like I will always go back to it as a line of questioning.
I love it. Yeah, it's I actually, is it Seth Godin, the marketing guru expert guy? Godin, I don't know how you say his last name, but he always says that, like, that is one of the biggest things when he decides to even work with a company or anything. That story, more than anything, about why they're passionate about it, and what he goes, like, that can be one of your biggest differentiators if you're so passionate about your story. So I've met some people in healthcare that are like, I just need to find the right problem. I'm looking for that problem. And those are the founders that worry me, because if they don't have that strong tie, like if they didn't face the problem or they didn't have that personal experience, it's probably not going to necessarily go that well for them. And I think the cool part about healthcare is probably so many of these pitches you hear, especially on the patient facing, is someone had that personal story of it was, a family member or someone else that they knew was going through a rough time in healthcare, and that's why they decided to build this business. So I like that point. Branden, anything that you wanted to add now from like because I know you probably need to see some different things as well.
Yeah, I mean, I'll continue on that point. I mean, I'll put it a different way, which is that unique relationship, Brad, you mentioned. We love to see management teams that have like an advantageous understanding of the pain point, and that might come from personal experience. It might not, but those who have an advantageous, like an unfair information advantage, especially in healthcare, because it's like such an insider industry. Like you kind of have to have lived it in many cases, not all cases. So agree there. I think from going along that founder attributes that we like. So have people that I think are purpose driven, that are in it for the mission, is really important. Like they're not just in it for the money, which may sound like an obvious thing, but I mean it's not. Like I look at my like the investments I've made or our broader portfolio, like not all of them, after you're in it with them for several years, you realize, oh, they're not truly purpose driven. And the reason that is important is it's not some emotional thing. It's more a matter of sustainability and resilience, because it's something always goes wrong, and every company at some point will go through a pivot. And someone who's driven by something deeper than just like professional success are the ones that are going to make it, oftentimes, most of the time. So agree on all that. I think one other like non-obvious kind of nuance that we look at beyond the straightforward stuff, and like straightforward evaluation criteria, is really not being a technology looking for a problem. Uh, Rather the other way around. Like you've identified the problem and the needs of a specific customer market or a segment of the market, and you are tailoring your solution to fit those needs, versus like you build this slick technology, back to my point around AI, and you're like looking for a problem and trying to find a way to monetize it. Really having a well-defined set of use cases that actually you are solving with clear business value, and there's a clear value prop to the right stakeholders, is something we really focus on.
I like it. And when you guys are, let's say someone just sends you their deck before there's that meeting, right? Brad, you were talking about it. Your email's up on the site. Someone's going to email you. You're more than likely going to read that email, right? They just send you a deck for some reason, right? They just, out of the blue, no relationship. What do you want to see on that deck that says, I'll reply to this email and say, let's talk more?
I think clarity of thought is really important. I mean, the way that you communicate your message in various mediums, like via email, via your marketing deck or pitch deck or whatever it is, that says a lot just about how you communicate with the market more broadly. And so it's really important to be able to, like, in a concise way, communicate value and communicate differentiation. And so I think about those things. Certainly there are a lot of things that I don't understand in pitch decks, maybe because they're out of my technical area of expertise, or it's just a new market opportunity that I haven't thought about before. But I should be able to, like, relatively quickly grasp what we're talking about, again, to Branden's point, like what the problem is, what general market we're going after. And I think that's kind of a miss that I probably see most frequently.
Yeah, I strongly agree with that. I would add, so in addition to clarity, I would add transparency. There are, I mean, most pitch decks are overly generic. Either they're overly generic, which kind of ties into clarity, I suppose, but also like they're hiding the ball on where they're really at. Like
Yep.
how many, like, who are your customers? What are your financials? What value have you delivered? And, it's not like I need to see all of this detailed, sensitive information at first blush. That's not what I'm saying. What I am saying is when companies like either do a poor job of representing what they really do or where they're really at in their stage, or maybe they're intentionally trying to misrepresent just to get on the phone with you. I don't like that. It's a waste of time.
That's such a good point. I think there's there's definitely some like gamesmanship, but that is especially in early stage venture. Like trust is probably the number one thing that we're kind of going off of and evaluating, even if it's a secondary point. Like we're evaluating the person sitting at the other side of the table and like whether we want to work together for a long period of time. And so anything like evasiveness or caginess around, the true traction or numbers or even kind of business model, like that is a huge turnoff for me. Because we like inherently are at such an information disadvantage as investors. Like we're fully reliant on entrepreneurs. And that is the way it should be. Like we take a fairly light touch in terms of like governance. And so we really need to trust the people that we're working with. Yeah, it's a good point, Brandon.
Interesting. Sorry, were you going to say something, Brandon?
No, it's I can tell Brad we could commiserate over endless interactions with some of these. I mean, again, I think most of the time it's not intentional. I just think entrepreneurs oftentimes have, especially at our stages, have a lack of sophistication of like how you engage with investors, how you run a process. And so you have to coach them most of the time versus trying to do like forensic analysis because they're hiding something. So I don't think entrepreneurs are mostly disingenuous. It's more of just like they don't know how to communicate, or they think it's kind of like a negotiation where they don't know what the important points are to negotiate, so they focus on things that don't matter. I think it comes with just that naivete.
I think this is the exception, by the way, not the norm. So yeah, it's maybe not as big of a problem as as we're spending time on, but for us, I actually think that there's some coaching that happens around representing yourself larger than you are, or like grabbing metrics that are sort of nonsensical. I always kind of laugh at like the new metrics that like jump up in pitch decks that like are represented as financial metrics. And so, yeah, some of those things I think are just unnecessary. Like we invest pre-revenue, so there's no revenue. Like I don't need to see a 5-year projection on from 2024 onwards. And it's just those things are frustrating sometimes.
Interesting. Yeah, it's that is something that you probably see a lot more with first-time founders, right? Those like 5 years that's actually one of the biggest frustration points for early stage founders too, that they don't know where to start from. They think that you want to see those 5-year projections, and they spend probably far too much time on it, and they'll never hit those 5-year projections, more than likely, from your experience, right? It's because they're just plugging numbers in to build out a model that they think will appease you.
I just think it's an exercise in kind of like false precision. Like actually a lot of the businesses will like completely blow past those projections. But they often just like don't unfold in the way that is expected.
So in those scenarios, what would you rather see them focus in on, like more so the insights around the business model than even the projections in that case, and then how the business model will evolve over time?
I mean, sorry, Brandon, I'll just go very quickly here. I think it depends on whether you're kind of like what stage you're at. If you're seed or pre-seed, pre-revenue, it's a very different conversation than if you're, raising a Series A and you have some customers. So for us, yeah, if it's very early stage, like let's talk about who the target customer is and like what conversations you've had and what you've learned from those conversations, and like what price discovery work that you've done. And I don't need to see like 2024 projected revenue if you haven't landed a contract yet.
Makes sense.
Yeah, it's interesting to hear that. I've personally, the only pre-revenue company I've been involved with was back in like my previous life in life sciences, like pre-revenue biotech, like even pre-FDA. Um, we put a lot of work into the financial model, and the need to have projections in a financial model from the management team isn't so much because we take their word for it on their forecast. It's more to understand a couple things. One, the mechanics of just how their business works. Like, how do your unit economics work? What are the growth levers? What are the margin levers? What does your operating base look like today? How many employees do you have? What's your hiring plan? Like all of this that we look at in their model is a combination of, yeah, understanding how it works mechanically, but also understanding what their plan is and what they're doing with the money that they want to raise, and ultimately path to meeting certain growth milestones, or maybe profitability if they're farther along. Um, and then the companies we look at, since they're revenue generating, they already have at least a few customers, and so you can begin to see emerging adoption patterns and trends that the later they are, obviously the more you can extrapolate on that. But then you overlay that with like the customer pipeline, and the conversations you're having with prospective customers. And then we'll triangulate that with just, benchmark growth levels, adjusting for scale, of course, with companies, that we've seen just along the way, including those in our portfolio. So we put a lot of emphasis into that. But what we don't do, and this is like what keeps us, I guess, in the venture category, is we are not going in building these overly detailed models, really trying to understand the the overly precise cash needs like a private equity firm might, and different levers we can pull to make it more and more efficient. Like, it's all about growth and expanding margins in the future. Because these companies are all, like, companies we invest in, all of them except one are unprofitable. So we're kind of in the middle, I guess, between SpringTide and like purely growth equity or private equity. That's how I would characterize it.
And then after you both invest in companies, what type of communication do you like to see from there, in terms of updates and, like, I guess, what do you want to see in an update? How frequent do you want to see that update? Do you want to have these quarterly phone calls? Like, what does that look like for both of you? Why don't we kick it? We'll start with you, Branden, this time, and then we'll kick it over to Brad.
Sure. Yeah. So, I mean, at a bare minimum, we have board meetings every quarter, and we're on the boards of our businesses. We take board seats. So, a quarterly board meeting at the very least. And then from there, additional updates kind of depend on the success of the company and the stage. So, companies that are very scaled, like our most scaled company is over $1 billion in revenue. Like, we're not doing monthly updates with that company. It's like quick quarterly check-ins. Okay, everything's going great. We're a spec on your cap table at this point. Okay, cool. Let us know if we can help. And sometimes we'll have ad hoc calls with the CEO. Whereas like earlier stage companies, because we tend to invest, when they're still trying to scale and maybe they've reached initial product market fit, but there's a lot of coaching. So, in the earlier stages, we'll have monthly standing calls to review the business, what's going well, what's not, how can we be helpful. And then sometimes, when certain events are occurring, like a new financing, or maybe they're entering a new space, like a new product launch or a new market, then we'll be more, more hands-on, and it'll be much more frequent than that. And obviously, if things are not going well, which obviously happens, that's when the updates and the touch points become much more frequent. When we become like operators with the leadership team, and sometimes we'll bring in even more resources for those times, beyond just the deal team, the people who originally did the deal. So long way of saying it depends on the stage and just the profile of the business.
Yeah, I mean, I have entrepreneurs who I work with on a weekly or even more frequent basis. We're helping them hire. We're talking about their product roadmap. We're like, very, very close. And other entrepreneurs who, we hear from them on a monthly basis in a board meeting, and either one's fine. I frankly, I don't really have a preference. I think it's very, very tailored to the individual entrepreneur and the founding team, and also just the situation that they're in. I mean, we tend to lean in around hiring, around go-to-market, but we are not operators, and we don't purport to be operators, and we don't want to be operators. So it's very much, we're there when we can add value.
Well, I want to thank you both, by the way, for coming on, sharing some thoughts with us here today. We'll end on that. Really appreciate your time, and best of luck to both of you. Congrats on the new roles, and look forward to continuing to follow along with your portfolio companies.
Thank you.
Yeah, it was fun. We'll see you at Health, I'm sure.
Good seeing you, Brad. Let's connect separately so we can see each other.